Everyone, I'm back with video another chapter question answers from ICI Study Mat. That is chapter number 10, which is aggregation of income, set of or carry forward of losses. Okay, so the PDF link you will get in the description. Okay, do watch the video till the end, and don't forget to subscribe the channel if you have not subscribed, and also click on the bell icon for more updated videos. Okay, let's start. In this video I'll be covering all the illustration exercise questions as it is a small chapter. Okay, so let's start with illustration number 1. Mr. A, aged 35 years, submits the following particulars pertaining to the assessment year 2021. Okay, income from salary, it is computed salary, so all the deduction whatever deduction was there, it has already been, after deducting all the deduction, the amount is coming to 4 lakhs. So it is a computed salary income. Okay, losses from self-occupied property, okay, it is 70,000. Losses from let out property is 1,50,000. So loss from the house property is total coming to 2,20,000. Okay, so business loss is 1 lakh, and bank interest FD received is 80,000. So as you all know that business loss cannot be set off, okay, against salary, and the house property loss can be set off against any income, okay, any other heads of income up to only 2 lakh rupees. Okay, so in this case the 2 lakh 20,000 loss is there, and income from salary, it can be adjusted only up to a amount of 2 lakh in the same financial year. Okay, and so in this case 2 lakh only will be adjusted against salary. Okay, and loss from business loss can be set off against income from other sources, so it will be set off against up to a limit of 80,000 only, because bank interest income is only up of 80,000. so loss after that, that is 20,000 loss left, that will be carried forward to next assessment year. And as you all know that any heads of income loss is carry forward, then it is set off against only that head of income only in the next year. In the same year it can be set off against any other heads, but in next assessment year it can be set off only against the same head. Okay, so in this case 2 lakh will be adjusted, 2 lakh of house property loss will be adjusted against salary. So after adjustment, salary income will be left of 2 lakh, that will be chargeable, that will be included in the total income, and business loss will be 20,000, it will be carried forward, and the house property loss 20,000 will be carried forward. Let's see the solution. Computation of total income for Mr. A for the assessment year 2021. Okay, so particulars rupees, amount is given, 2 column is made for amount. So income from salary is 4 lakh, loss less loss from house property of 2,20,000 to be restricted to 2 lakh by virtue of section 71(3)(a). Okay, as I said 2 lakh will be adjusted, so income from salary after adjustment is coming to 2 lakh. Okay, so balance loss of 20,000 from house property to be carried forward to next assessment year. Okay, so income from other sources is 80,000, that is interest on fixed deposit with banks, that is 80,000. Business loss set off, okay, business loss of 20,000 to be carried forward for set off against business income of the next assessment year. So 80,000 is set off. Okay, after adjustment of 80,000 no income is left, and 20,000 balance of a loss is left, it will be carried forward to next assessment year. Okay, and this gross total income is coming to 2 lakh, and less deduction, the chapter 6 says nil, so total income is 2 lakh. Hope you have understood. There is a note, there will be note on that. Note: gross total income includes salary income of 2 lakh after adjusting loss of 2 lakh from house property. The balance loss of 20,000 from house property to be carried forward to next assessment year for set off against income from house property for that year. Okay, as I told that any income which is any head of loss is carried forward to next assessment, it can be set off only against the same head only. So house property loss is 20,000 carry forward, in the next assessment year it will be set off only against house property income only. Okay, now business loss of 1 lakh rupees is set off against bank interest of rupees 80,000. and remaining business loss of 20,000 will be carried forward as it cannot be set off against salary income. As I told, business loss cannot be set off against salary income, so 20,000 loss has not been set off against balance of salary income, so it will be carried forward. Business loss will be carried forward. Okay, hope you have understood. Now moving to next illustration. Illustration number 2. Okay, Mr. B, a resident individual, furnishes the following particulars for the previous year 1920. Okay, income from salary computed, it is 45,000. Income from house property, that is a loss of 24,000. Income from business non-speculative, that is also loss of 22,000. Income from speculative business 4,000, that is a loss. Okay, and short-term capital loss is 25,000 and long-term capital gain is 19,000. Okay, what is the total income chargeable to tax for the assessment year 2021? So as I said in the previous sum, business loss cannot be set off against salary income. So in this case 45,000 salary is there, and this salary income, from the salary income, loss from house property will be adjusted, so it is within the limit of 2 lakh. So entire amount of loss from house property will be set off. Okay, and business loss, that is 22,000, will not be set off against salary, and speculative business income loss can be set off in the same and in the next assessment only against speculative business income. So there is no speculative business income, so it 4,000 will carry forward. Let's see whether we can adjust 22,000 or not. So there's a short-term capital loss of 25,000. Okay, so there is no restriction on short-term capital loss, that is short-term capital loss can be set off against long-term capital gain. So in this case short-term capital loss can be adjusted against short-term capital gain as well as long-term capital gain. So in this case 25,000 loss is there, that is short-term capital loss, and long-term capital gain is 19,000. So only up to a limit of 19,000 short-term capital loss will be set off and it will be carried forward. So in this case 22,000 business loss and 4,000 speculative business loss, that will be carried forward as it cannot be set off against any other income in the current year because no other income is there other than salary. So it will, both the 22,000 4,000 will be carried forward. House property will be set off against salary, and short-term capital loss will be set off only a limit up to a limit of 19,000 against long-term capital gain. So let's see the solution. Total income of Mr. A for the assessment year 2021. Okay, income from salary is 45,000. Income from house property 24,000. As I said, it will be adjusted. So after adjustment 21,000 income from salary is left. Okay, now profit and gain from business or profession. Business loss to be carried forward 22,000. There is a note given there. We'll see to the note. Speculative loss of to be carried forward, that is 4,000. It will be carried forward. There is another note for that, note number 2. And now capital gain loss, long-term capital gain is 19,000. Short-term capital loss is 25,000. So short-term capital loss to be carried forward, that is 6,000. It will be carried forward in next year. So taxable income is 21,000. So there is 3 notes. Let's see the note. Note 1. Business loss cannot be set off against salary income. As I said, business loss we cannot set off in the against salary income. Therefore loss of 22,000 from non-speculative business cannot be set off against income from salary. Hence such loss has to be carried forward to the next assessment next year for set off against business profit, if any. Okay, in the next year it will be set off only against business income only. Okay, now note number 2. Loss of rupees 4,000 from speculative business can be set off only against the income from speculative business. Hence such loss has to be carried forward. So they, as I said, speculative business loss can be set off against only speculative business income. Okay, now note number 3. Short-term capital loss can be set off against both short-term capital gain and long-term capital gain. Therefore short-term capital loss of rupees 25,000 can be set off against long-term capital gain to the extent of 19,000. Okay, the balance of short-term capital loss of 6,000 cannot be set off against any other income, and hence it has to be carried forward to the next assessment next year for set off against capital gain, if any. Okay, so as you all know that it is written in the provision that loss on the head capital gain cannot be set off against any other head of income. Okay, so in this case that is why 6,000 loss left, it has not been adjusted against salary income of 21,000 left. Okay, so 6,000 loss will be carried forward in this case. Hope you have understood. Now moving to next illustration number 3. During the previous year 1920, Mr. C has the following income and brought forward losses. Okay, short-term capital gain. Short-term capital gain on sale of shares is 1,50,000. Brought forward long-term capital gain, capital loss of assessment year 18-19 is 96,000. Okay, this is a brought forward long-term capital loss 96,000. Short-term capital gain. Short-term capital loss of assessment year 19-20 is 37,000, and long-term capital gain is 75,000. So first will short-term capital loss will be adjusted against short-term capital gain. Okay, that is 1,50,000 income is there from short-term capital gain. So 1,50,000 minus 37,000, that is 1,13,000 will be short-term capital gain. Okay, after adjustment of 37,000, and long-term capital gain is 75,000, whereas brought forward long-term capital loss is 96,000. So 96 up to extent of 75,000 long-term capital loss, which is brought forward loss, can be set off up to a rupees 75,000, which is the long-term capital gain. So 21,000 long-term capital loss will be carried forward. Okay, let's see the solution. What is the capital gain taxable in the hands of Mr. C for the assessment year 2021? Okay, now let's see. Taxable capital gain of Mr. C for the assessment year 2021 will be short-term capital gain on sale of shares is 1,50,000. As I said, it will be set off against short-term. This income will be from this income will adjust the short-term capital loss. So less brought forward loss, short-term capital loss for the assessment year 1920, that is 37,000. So balance short-term capital gain is left is 1,13,000. Okay, now long-term capital gain is 75,000, less brought forward long-term capital loss of assessment year 18-19 is 75,000. So 96,000 was there, so 75 up to a extent of 75,000 will be adjusted. So 75,000 has been adjusted. Long-term capital gain after that is nil. So taxable short-term capital gain is coming to 1,13,000. Okay, there's a note. Long-term capital loss cannot be set off against short-term capital gain. Okay, there is a restriction that long-term capital loss cannot be adjusted against short-term capital gain, whereas short-term capital loss can be adjusted against long-term capital gain, as we have seen in the previous sum. Okay, hence the unadjusted long-term capital loss of assessment year 18-19 of rupees 21,000, that is 96 minus 75,000, has to be carried forward to the next year to be set off against long-term capital gain of that year. Okay, that 21,000 will be carried forward long-term capital loss and will set off against only long-term capital gain only. Okay, it's clear. Now moving to next illustration number 4. Mr. D has the following income for the previous in 1920. Okay, income from activity of owning and maintaining the racehorse, that is 75,000. Income from textile business is 85,000. Income brought forward textile business loss is 50,000. Okay, this 50,000 loss will be set off against 85,000 textile business income. Okay, now brought forward loss from activity of owning and maintenance of racehorse is 96,000. Okay, so as you all know that loss of owning and maintenance of racehorse can be adjusted only against income from activity of owning and maintenance of racehorse. Okay, so in this case only 75,000 income is there from income from owning and maintenance of racehorse. So loss is 96,000. So 21,000 loss after adjustment will be carried forward, as in the current year income from owning and maintenance of racehorse is only up to 75,000. Okay, and business income after set off of losses of 50,000 will be 35,000 left. Okay, so what is the total income in the hands of Mr. D for the assessment year 2021? Okay, let's see the solution. The total income of Mr. D for the assessment year 2021, income from activity of owning and maintenance racehorse is 75,000, less brought forward loss from owning and maintenance of race horse is 96,000. So 75,000 will be adjusted and 25,000 loss will be carried forward to next assessment year. So loss from activity of owning and maintenance of racehorse to be carried forward to assessment year 2021 will be 21,000. Okay, now income from textile business is 85,000, less brought forward business loss from textile business is 50,000. So after adjustment of this loss of 50,000, income from textile business left is 35,000. So total income will be 35,000. Okay, now let's see the note. loss from the activity of owning and maintenance of race horses cannot be set off against any other sources or heads of income. As I said, that loss from owning and maintenance of race horse cannot be set off against any head of income, any head or any income, okay, from the same head or other heads as well. It cannot be set off. Okay, hope it's clear. Now moving to next illustration number 5. Mr. E has furnished his details for the assessment year 2021 as under: income from salary, it is a computed salary, so no adjustment is required, 1,50,000. Income from speculative business is 60,000. Loss from non-speculative business is 40,000. Okay, so this non-speculative business loss can be adjusted against speculative business income. There is restriction on loss of speculative business. Okay, it cannot be adjusted against any other business. Okay, but in this case it's a reverse case, that is loss from non-speculative business is there, so it can be set off against speculative business. Okay, so now again next, short-term capital gain is 80,000, long-term capital loss is 30,000. So long-term capital loss cannot be set off and it will be carried forward to next assessment year, as it can be set off only against long-term capital gain, okay, in the same assessment year as well as the next assessment year. Okay, winning from lottery is 20,000. So in this case, let's see the solution. What is the taxable income of Mr. E for the assessment year 2021? Computation of taxable income of Mr. E for the assessment year 2021. Income from salary, it is 1,50,000. Income from speculative business is 60,000. Okay, it will be adjusted. There's less loss from non-speculative business, so it will be adjusted against speculative business income. So after that, speculative business income left is 20,000. Okay, short-term capital gain is given because no adjustment is been made from this short-term capital gain. Winning from lottery is 20,000. Okay, there is a note given for the long-term capital loss. Long-term capital loss can be set off only against long-term capital gain. Okay, therefore long-term capital loss of 30,000 has to be carried forward to the next assessment year. Okay, it will be carried forward to next assessment year. Hope it's clear. Now moving to illustration number 6. Compute the gross total income of Mr. F for the assessment year 2021 from the information given below. Okay, income from house property is a computed income, so it will no adjustment is required, that is 1,25,000. Income from business before providing for depreciation, that is 1,35,000. Okay, short-term capital gain on sale of shares is 56,000. Long-term capital loss from sale of property, brought forward loss from assessment year 17/18 is 90,000. Okay, so income from tea business is 1,20,000. Dividend from Indian company carrying on agriculture operation 80,000. Okay, and current year depreciation is 26,000, and brought forward business loss, that is loss incurred 6 years ago, that is 45,000. Okay, so hope the question is clear. So in this case, 1,25,000 house property loss is there. There is a business income, okay, that is 1,35,000, that is before depreciation. From this we'll adjust the 26,000 depreciation first, current year depreciation, and we'll adjust the brought forward loss of 45,000. Okay, and then the amount will be coming to 64,000. Okay, and short-term capital gain is there and long-term capital loss is there. Long-term capital loss can be set off only against long-term capital gain, so no adjustment can be made. Okay, it will be carried forward to next assessment year. Income from tea business, that is 1,20,000. So from 1,20,000, 60% is exempt, only 40% taxable. So from that 40% will be the business income. We'll see to that. And dividend income from Indian company, it is exempt under section 1034 up to rupees 10 lakh. So it is 80,000, so it will be exempt. Okay, so hope you have understood. Let's see the solution. Gross total income of Mr. F for the assessment year 2021. Income from house property is 1,25,000. Okay, income from business 1,35,000, and less current year depreciation, as I said, 26,000, and less brought forward losses is 45,000. So after adjustment of this, both the loss and depreciation, the amount is coming to 64,000. Okay, and income from tea business, it was 1,20,000. Okay, on 1,20,000, 40% is tax business income, so only 40% has been taken of 1,20,000 is coming to 48,000. So total business income is coming to 1,12,000. Okay, now income from capital gain, short term capital gain is 56,000. Okay, long term capital loss will be carried forward to next assessment year. Nothing is written for that, there is a note for that. So gross total income is coming to, that is 1,25,000 plus 1,12,000 plus 56,000. So total is coming to 2,93,000. Okay, now let's see the notes. Dividend from Indian company of rupees 80,000 is exempt from tax under section 1034. As I said, dividend income is exempt under section 1034. Okay, so next, 60% of the income from tea business is treated as agriculture income and therefore exempt from tax. As I said, 60% is exempt as it is an agriculture income. Only 40% is business income, so it has been considered in this case. Okay, now long term capital loss can be set off only against long term capital gain. Therefore long term capital loss of 90,000 brought forward from assessment year 17-18 cannot be set off in this assessment year 2021. It has to be carried forward for set off against long term capital gain, if any, during the assessment year 21-22. Sorry. Okay, hope it's clear. That's it with all the illustration questions. Okay, now let's start with the exercise questions. Okay, so question number 1, X carrying on business as a sole proprietor died on 31st March 2019. Okay, on his death the same business was continued by his legal heirs by forming a firm. Okay, Mr. X has died and it was the same business was carried on by his legal heir. Okay, and they are carrying on by constituting a firm. They have formed a firm and they are carrying on that business only of Mr. X. As on 31st March 2019, a determined business loss of rupees 5 lakhs is to be carried forward under the Income Tax Act 1961. Okay, this was the loss of Mr. X business that is to be carried forward as per the Income Tax Act. Does the firm constituting of all legal heirs of Mr. X get a right to have this this loss adjusted against its current income? Yes, in this case, as it was by way of inheritance. Okay, the legal heir can carry forward the loss of Mr. X business as it was taken over the business by way of inheritance. Okay, so in this case loss can be carried forward by the firm, that is the legal heir. Okay, so let's see the solution. Section 78(2) provides that where a person carrying on business or profession has been succeeded in such capacity by another person other than by way of inheritance, then the successor is not entitled to carry forward and set off the losses of the predecessor against his income. Okay, if it is succeeded, then the successor is not entitled to carry forward and set off the losses except in case of inheritance. So if this is a case of inheritance, so they can carry forward and set off the losses. So this implies that generally set off of business loss should be should be claimed by the same person who suffered the loss, and only exception to this provision is when the business passes on to another person by inheritance. Okay, so there is only one exception, that SSC should be same, that in case of inheritance SSC might be different, but in all other cases SSC must be same. Okay, the person who has incurred the loss and who is claiming the loss or carry forwarding the loss. Okay, so the fact of the case given in the question are similar to the case of CIT versus Madhukant M. Mehta 2001 247 ITR 805, where the Supreme Court has held that if the business is succeeded by inheritance, the legal heir are entitled to the benefit of carry forward of losses of the predecessor. Okay, even if the legal heir constitute themselves as a partnership firm, the benefit of carry forward and set off of losses of the predecessor would be available to the firm. Okay, even if in case of inheritance, even if the proprietorship business is being converted into partnership firm and they are setting off the losses, legal heir are setting off the losses, they can even set off that loss. Okay, So in this case, the business of X was continued by his legal heir after his death by constituting a firm. Hence the exception contained in section 78(2) along with the decision of the apex court, that was upper decision discussed above, would apply in this case. Therefore the firm is entitled to carry forward the business loss of rupees 5 lakh of X. Okay, so they can carry forward the business loss of rupees 5 lakh of Mr. X. Okay, hope it's clear. Now moving to question number 2. ABC Limited was amalgamated with XYZ Limited on 1st April 2019. All the condition of section 2(1)(b) were satisfied. Okay, it was amalgamated. ABC Limited is amalgamated with XYZ Limited on 1st April. Okay, ABC Limited has the following carry forward losses as assessed till the assessment year 1920. Okay, so the carry forward loss of ABC Limited is given. Speculative losses, that is 4 lakh. Unabsorbed depreciation is 18 lakh. Okay, and unabsorbed expenditure of capital nature on scientific research is 2 lakh. Business loss is 120 lakhs. Okay, so it is written in the provision of set off and carry forward losses that only business loss, okay, can be carried forward by the successor, okay, except speculative business loss. So in this case 4 lakh loss will not be set off, and the successor cannot claim the set off of speculative business loss, that is X Limited cannot set off of 4 lakh speculative loss of ABC Limited. Okay, rest of the other unabsorbed depreciation, unabsorbed expenditure on capital nature on scientific research, okay, and business loss can be set off by ABC Limited. Okay, there is another thing written in that unabsorbed capital expenditure on scientific research will have the same treatment as that of the depreciation. Okay, now let's see what the question is further saying. XYZ Limited has computed a profit of rupees 1,40,000 for the financial year 1920 before setting off of the eligible losses of ABC Limited, but after providing for depreciation at 15% per annum on rupees 1,50,000 being the consideration at which plant and machinery were transferred to XYZ Limited. Okay, so the ABC Limited asset, okay, which was transferred to XYZ Limited at 1,50,000. Okay, so on 1,50,000 XYZ Limited is claiming 15% depreciation. Okay, let's see what the question is saying next. The WDV value, written down value as per the income tax record of ABC Limited as on 1st April was 100 lakh. So 100 lakh assets, on 100 lakh assets whose WDV was 100 lakh, XYZ Limited is claiming depreciation on 150 lakhs. So excess 50 lakhs they are claiming depreciation. So on 50 lakhs excess depreciation, on excess amount of depreciation should be disallowed. Okay, so it will be added back, that is on 50 lakh if we'll compute 15% on that will be added back. Okay, we'll see in the solution. Okay, let's see what the question is saying next. The above profit of XYZ Limited includes speculative profit of rupees 10 lakh. Okay, so in this 1,40,000 speculative profit is also given. So though no adjustment is required for speculative profit, because speculative profit can be adjusted against any other profit. Okay, but speculative loss cannot be set off against any other profit. Okay, so in this case speculative loss of ABC Limited cannot be set off in this case, because successor cannot carry forward and set off the losses only of speculative loss of the predecessor. Okay, so in this case 4 lakh of speculative loss of ABC Limited cannot be set off by XYZ Limited. Okay, so let's see. Computation of total income of XYZ Limited for the assessment year 2021. Business income before set off of brought forward losses of ABC Limited. Okay, so it's coming to 1,40,000. So it is in this 1,40,000 speculative income is also included. Okay, no issue with that. So next, add excess depreciation claimed in the scheme of amalgamation of ABC Limited with XYZ Limited. Okay, so excess depreciation, as I said, so on 50 lakh we'll compute 15% of that, that is coming to 7,50,000. Okay, let's see. Value at which asset are transferred by ABC Limited is 1,50,000. WDV written down value in the books of ABC Limited is 100 lakh. So excess accounted is 50 lakh. Okay, excess depreciation claimed is in computing taxable income of XYZ Limited is 50 lakh into 15%, that is coming to 7.5 lakhs. Okay, as per the explanation to section 43(6). Okay, it will be added back. Okay, now so profit is coming to 147.5 lakhs. Okay, now we'll set off the business loss first. Set off of a brought forward business loss of ABC Limited, that is 1,20,000. Now there's a note for that. Note 2 and 4 we'll see to that later. Now if we'll set off of unabsorbed depreciation under section 32(2), read with section 72A, we'll see to note in 2 to 4, that is 18 lakh. Set off of unabsorbed capital expenditure under section 35(1)(4), read with section 35(4). Okay, 2 lakh. That is business income is coming to, after adjustment of all the losses of ABC Limited, is coming to 7.5 lakhs. Speculative business loss of ABC Limited cannot be adjusted, because as it is said that speculative business loss cannot be carried forward by the successor. Okay, let's see the note. It is presumed that the amalgamation is within the meaning of section 72 of the Income Tax Act 1961. Okay, in this case, amalgamation of companies, the unabsorbed losses and unabsorbed depreciation of amalgamating company shall be deemed to be the loss or unabsorbed depreciation of the amalgamated company for the previous year in which the amalgamation was effected, and such business loss and unabsorbed depreciation shall be carried forward and set off by the amalgamated company for 8 assessment years and indefinitely. Okay, so they will get a fresh 8 years for carry forward the business loss. Okay, amalgamated company will get fresh 8 years for the carry forward business loss, and unabsorbed depreciation, as you all know, can be carried forward indefinitely. For that it is written indefinitely. Okay, for the business loss it is given that they will get a fresh 8 assessment years, as the business loss of ABC Limited will be considered as XYZ Limited's current year business loss, so they will get a fresh 8 assessment years for carry forward of losses, and for unabsorbed depreciation it can be carried forward indefinitely. Okay, now moving to note number 3. As per section 72A(7), the accumulated loss to be carried forward specifically excludes loss sustained in speculative business. Therefore, speculative loss of rupees 4 lakh of ABC Limited cannot be carried forward by XYZ Limited. As I said, that speculative business loss of ABC Limited cannot be set off by XYZ Limited. Okay, it was as it is mentioned in the provision. Okay, moving to note number 4. Section 22(2) provides that where any allowances or part thereof unabsorbed depreciation under section 32(2), okay, unabsorbed, sorry, I'm reading it once again. Section 72(2) provides that where any allowances or part thereof unabsorbed under section 32(2), that is unabsorbed depreciation, or section 35(4), that is unabsorbed scientific research capital expenditure, is to be carried forward, effect has to be first given to brought forward business losses under section 72. So first we have adjusted business loss, then we have adjusted depreciation, then we have adjusted unabsorbed scientific research capital expenditure. First we have to give preference to unabsorbed, that is first we have to give preference to business loss. So if they have given first preference to business loss, that is why. Okay, 120 lakh. Okay, so moving to note number 5. Section 35(4) provides that provision of section 32(2) relating to unabsorbed depreciation shall apply in relation to deduction allowances under section 35(1)(4) in respect of capital expenditure on scientific research related to business carried on by the SEC. Therefore, unabsorbed capital expenditure on scientific research can be set off and carried forward in the same manner as unabsorbed depreciation, as it is written under section 32 to that it will have the same treatment as that of the unabsorbed depreciation. Unabsorbed capital expenditure will have the same treatment, will be treat it same as unabsorbed depreciation. Okay, Hope it's clear. So unabsorbed depreciation, capital expenditure can be set off and carry forward as same as unabsorbed depreciation. Hope it's clear. Now moving to note number 6, which is the last note of this question. The restriction contained in section 73 is only regarding set off of losses computed in respect of speculative business. Okay, such a loss can be set off only against profit of another speculative business and not non-speculative business. However, there is no restriction under the Income Tax Act regarding set off of normal business loss against speculative income. Therefore, normal business loss can be set off against profit of speculative business. So that is why that is from 1,40,000 they have not separated speculative business income, because speculative business income can be set off against non-speculative business loss. Okay. Consequently, there is no loss or allowances to be carried forward by XYZ Limited to the financial year 2021. So all that, after adjusting all the losses and all, no loss is left. So, and speculative business loss cannot be carried forward or adjusted by the successor. So no loss is there that should be carried forward. Hope it's clear. Now moving to question number 3. Examine in brief about the treatment to be given in the following case under the Income Tax Act 1961 for the assessment year 2021. Okay. Loss of rupees 85,000 was sustained by Simran in the activity of owing and maintenance camel for races. Okay, there is a restriction for owing and maintenance. Loss of owing and maintenance of racehorse can be set off against only loss of income of owing and maintenance of racehorse. Okay, so loss from owing and maintenance of racehorse can be set off only against profit from owing and maintenance of racehorse in the same assessment in the same year or in the next assessment year. Okay, but there is a no restriction in the provision that owing and maintenance of loss from owing and maintenance of camel for races, it cannot be set off against. There is no restriction like that. So it is only for horses, owing and maintenance of race horses. That loss can be set off only against owing and maintenance of income from that head only. So in this case, it can be set off against any income under the same assessment year, any head of income, or in the from the same head or from any other head. Okay, in the same year. And for next assessment year, it can be set off only if it is a business income. So it can be set off against any business income. Okay, let's see what the answer is saying. Section 74A3 lays down the provision for set off and carry forward losses from activity of owing and maintenance race horses. Okay, according to provision of section 74A3, the loss incurred by an assessee from activity of owing and maintenance of race horses cannot be set off against the income from any other source other than the activity of owing and maintenance of race horse. As I said, that owing and maintenance of race horse loss can be set off only against income of owing and maintenance of race horse. Okay, since the scope of this section is confined to the activity of owing and maintenance of race horses only, therefore set off and carry forward of losses from activity of owing and maintenance of camels is not covered under section 74A3. So it is not covered there. So it can be set off against any other head in the same assessment year. And it will be, if it is a business income, in the next assessment year, if it is carry forward, then it can be set off only against business income. Okay, it is possible to take a view that the loss from activity of owing and maintenance of camel for races, okay, may be governed by section 72 provided such activity amounts to business. Okay, accordingly, the loss from the activity of owing and maintenance of camels for races can be set off against any income that is other than salary. As you all know that business income cannot be set off against salary, so it won't be set off against the salary in the current year, and unadjusted amount shall be carried forward for set off against any business income for a maximum period of 8 assessment years immediately succeeding the assessment year in which the loss was incurred. As you all know that business loss can be carried forward and set off for 8 assessment years after the assessment year in which loss was incurred. Okay, hope it's clear. Now moving to question number 4. Mrs. JKLM, a firm consisting of 4 partners, namely JKLM. Okay. They shared profit and loss equally during the year ended 31st March 2019. Okay. The SEC business loss of the firm for the assessment year 1920, which is entitled to be carried forward, amounting to rupees 3,60,000. So assessment year 1920 loss is 3,60,000. Okay. A new deed of partnership was executed among JKLM on 1st April 2019, in terms of which they agreed to share profit and loss in the ratio of 15:15:20:50 respectively. Okay. Compute the amount of business loss relating to the assessment year 1920, which the firm is entitled to set off against its business income for the assessment year 2021. Okay. The business income of the firm for the assessment year 2021 is 3,30,000. Your answer should be supported by reason. So in this case, there is an exemption for the provision that if there is a same partner, okay, of a partnership firm, if there is a same partner and their profit sharing ratio is changed, then there is no restriction for the set off of losses. So in this case, there is a change in profit sharing ratio, so it will not be considered as change in constitution of the firm. So the loss of 3,60,000 can be adjusted against 3,30,000, and balance 30,000 will be carried forward for the next assessment year. Okay. The firm, let's see the answer. The firm is entitled to set off its business brought forward losses amounting to 3,60,000 relating to assessment year 1920 to the extent of 3,30,000 against its business income of rupees 3,30,000 for the assessment year 2021 as per the provision of section 72(1). Okay. The balance unabsorbed business loss of rupees 30,000 relating to assessment year 1920 will be carried forward to the assessment year 2021-22. Okay, it will be carried forward. So next, section 78(1), which deals with carry forward and set off of losses in case of change in constitution of the firm, is applicable only where there is a retirement or death of a partner. Okay. So if there is a retirement or death of partner, then only this restriction is there. Okay. It is noted, it is not applicable, it is not applicable to a case where there is a change in ratio of in the ratio of sharing profit and loss amongst the existing partner. Therefore section 78(1) is not applicable to the case of MSS JKLM. So there is no retirement, no death of partner. Okay. So in this case, there is only a change in ratio of sharing of profit and loss. So in this case, they can set off the losses. Okay. So moving to the last question of this chapter. An SSE sustained a loss under the head income from house property, okay, in the previous year relevant to the assessment year 1920, which could not be set off against income from any other head in that assessment year. Okay. The SSC did not furnish the return of loss within the time allowed under section 139(1) in respect of the relevant assessment year. So okay, in which the loss was incurred, they have not filed the return on time, that is before the due date, on or before the due date. Okay. However, the SSC filed the return within the time allowed under section 139(4), that is they have filed the belated return. Okay. But before the end of the relevant assessment year, because the time limit for filing of return for a particular financial year is by the end of the assessment year. Okay. Can the SEC carry forward such loss for set off against income from house property of the assessment year 2021? Yes, because there is no restriction on house property loss under section 139(3). Only in respect of business loss and capital gain loss there is restriction that return should be filed on or before the due date, otherwise you cannot set off of losses of business as well as capital gain. So in this case, house property is not covered under section 139(3). So in this case, house property loss can be carried forward and set off in the next assessment year, even if they have filed the return on or after the due date of filing of return. but return should be filed before assessment year. Okay, so they have filed the return, that is a belated return they file, so they can set off the carry forward and set off the losses in the next assessment year. Let's see the answer. Section 139(3) stipulates that an SSE claiming carry forward of losses under the head profit and gain of business or profession or capital gain should furnish the return of loss within the time stipulated under section 139(1). Okay, there is no reference to loss under the head income from house property in section 139(3), as I said. So there is no reference given over there for loss of income from house property, loss in respect of income from house property. Okay, the SSE in the instant case has filed the return showing the loss from house property within the time prescribed under section 139(4). Okay, the SSE is therefore entitled to carry forward such losses from for set off against the income from house property of the subsequent assessment year. Okay, hope it's clear. That's it with this chapter. Hope you have understood all the questions. This chapter is over. If there is a doubt, you can write me on the comment box. Don't forget to subscribe the channel, okay, and also share with your friends, okay, and also click on the bell icon for more updated videos. Okay, so anyone willing to solve indirect tax ICAI study mat questions, they can visit the link given in the description. Okay, thank you, bye bye.